If you've ever tried your hand at trading, you know exactly the feeling I'm talking about. You've got the best charts, instant information, all the tools in the world, but making consistent money just feels impossible. Well, today we're going to dive into the work of trader Tom Hougaard, and he argues that the answer isn't another fancy indicator, it's about completely changing the way you think.
So let's just tackle the elephant in the room. It's a huge paradox, isn't it? As Hougaard points out, we've got tools and data today that traders 20 years ago couldn't even dream of, and yet the failure rate is still sky high. So what is really going on here?
And boom, this quote from Hougaard absolutely nails it. Your problem isn't your chart, it's your brain. It's that weird quirk where the pain of losing $100 feels way worse than the joy of winning $100. It's called loss aversion, and it's hardwired into us. It's why we let our losing trades run, hoping they'll turn around, and why we cut our winners way too short.
Okay, so let's see how this human problem actually shows up when you look at the cold, hard data. Because, believe me, it's a pattern that trips up almost everybody. Now, get this. This data comes from a massive study of 43 million trades, and it's going to flip what you think you know on its head. The average trader wins 62% of the time. That's right, they are correct more often than they're wrong. So why do they lose money? Well, because they snatch their profits way too early, averaging just a 48-point gain. But they let their losers run wild, averaging a massive 82-point loss. It's a perfect recipe for slowly bleeding an account dry.
All right, so if our own psychology is basically setting us up to fail, what's the alternative? Well, this is where Hougaard introduces a completely different way to look at the markets, something he calls scenario analysis.
So what exactly is scenario analysis? Well, first, let's talk about what it isn't. It's not some automated magic indicator you just slap onto your chart. Nope. This is about rolling up your sleeves. It's a manual and, yeah, sometimes painstaking process of digging through years of data to find patterns, repeatable patterns that give you a real statistical edge you can actually trust when the pressure is on.
And this comparison just lays it all out perfectly. Your standard indicator tries to be predictive. It's always giving you real-time buy or sell signals. But scenario analysis? It's manual, and it's all about probabilities. It doesn't tell you what will happen. Instead, it gives you a historical roadmap of what is most likely to happen when certain conditions are met. It's a total shift from prediction to preparation. Now, that all sounds great in theory, but I know what you're thinking. What does it actually look like? So let's get into 3 real-world statistical setups that Hougaard uncovered with his research. So here's the first one. He calls it the Monday setup. The logic is really simple, something you can just watch for yourself. First, you just look at the high point from Thursday. Then on Friday, you see if the market can trade above that high. If it can't, if it fails to break it, that's a clear signal of weakness. And that simple 2-day pattern creates a really powerful statistical expectation for what's coming on Monday.
And here's the big payoff. After going back and charting over a decade of data by hand, Hougaard found that when this specific scenario plays out, there is a 95% probability that the market will trade down to or even below Friday's low on the following Monday. I mean, wow, that's not a guess. That's a serious statistical edge.
Okay, next up, market gaps. You know when the price opens way higher or lower than where it closed? Well, the chance of that gap getting filled on day 1 is about 58%. Basically a coin flip. But this is where the roadmap helps. If you just extend your time frame out to 3 days, that probability jumps all the way up to 78%. It's like a statistical magnet telling you there's a strong pull for the price to eventually return to that level.
And finally, check this one out. It's about time itself. Just 30 minutes into the US session, there is a 50-50 chance that the high or the low for the entire day has already been put in. But wait just 90 minutes, an hour and a half, and that probability skyrockets to 90%. Now, just knowing that can completely change how you manage a trade, right? It can keep you from bailing on a good position way too early.
So, what's the big picture here? What do we take away from all this? It's really about a complete shift in your philosophy, moving away from this illusion that you can be certain about anything, and instead embracing the raw power of probability.
So let's be super clear. Scenario analysis is not a crystal ball. It's a guide. It's a roadmap. It gives you a statistical edge, not a money-back guarantee. And most importantly, it shifts your focus from trying to predict the future to simply preparing for the most likely outcomes. You stop asking, what will the market do? And you start asking, based on history, what is the market most likely to do? That's a game changer.
Hey, if you found this breakdown useful, please do a solid and hit that like button. Share this and subscribe for more explainers just like it. It really truly helps us create more content for you.
So we'll leave you with this final question. You see, Hougaard's entire method was born from just being curious and being willing to do the hard work. So instead of searching for the next magic indicator, what if you started asking your own questions? What if you took one of those market truths you've always heard and actually went back and tested it yourself? What roadmap will you build?